and the spotlight. So good afternoon, good evening. That's February 18th, 2012. Ken Long here with the review of the weekend reports and daily trading plan for February 18th, 2012. I'll start with the weekend reports, then we'll do the daily trading plan, and then I want to go over some thought experiments using the regression line crossover system, and then also the ideas for swing traders, looking at the volatility-based Renko charts, and I'm going to show you how I'm thinking about that lately. All right, so we're in a bullish, quiet market. We're at 63 out of 100 on weekly RSI 14, so at the high end of normal. We finished Friday at 109 on the 10-day NDX, so we had it closed at a 10-day high, and it was almost 10% higher than the trading range was high. In other words, it was a significant breakout and closed at a high level. Percent stretch relative to the 200-day moving average is 9.2%, coded green, very strongly bullish. 5-day slope of the 50-day moving average at 0.85%. It actually came down a little bit. The slope got a little bit weaker, but it's still coded green, still very strongly bull. ADX 14 at 37, so it's above that critical 35 level at the upper end of strong trend for SPY. ATR percentage is at 1%. It actually got quieter this week, and that's very favorable for the long side as well. So we have a bull quiet market that's overbought on a short-term basis. The no change in the blended monthly rebalancing, the 26 ETF and the 13 ETF portfolios as shown, taking advantage of strength in the U.S. market. Next reevaluation will be on or about 1 March. In ETF2, the theoretical exposure is at 100%, model portfolios at 100%, and all of the positions need to have their stops raised because of the strong week for all those positions. Moving on. Oops. Just a quick look at the current ranking inside the blended monthly rebalancing. With the 13 ETFs, it's the risk on trade, small caps, tech, mid caps, then the spiders. Now that's an inversion from what we saw through all of last year when it was the U.S. large caps with their relative safety and their dividend payments were leading the way. Now it's risk on with smalls and technology. And then in the 26 ETF, financials, smalls, technology, mids. Brazil is still moving its way stealthy to the top here. EWZ and ILF, the Latin America, you can see how they are starting to leave some of the other brethren behind, like Asia and Europe. It's really the strength in emerging markets, specifically Brazil and Latin America, that's leading the way. At the bottom of the list for the 13, it's Treasuries, Australia, Japan. And then on the 26, it's Swiss franc, agriculture, gold, and now we've got the bonds. TLT and SHY have moved their way downward. Only treasuries around this cash are below their 4-month moving average in the 13s. And now you've got the treasuries, agriculture, and Swiss franc in the 26. So you can see we've shifted to risk-on posture around the world. Now looking at the market health check, vertical blue lines represent 10, 20, and 30-day look-back periods. The horizontal purple line at 137 represents the swing high from last year at 137, and that's really, once again, the boundary of the trading channel that SPY has been in, really from 116, which is about a 15% pullback, all the way up to 137. That's 21 points. You can see that the shaded blue area is the area below the 200-day moving average, which is the boundary between blue and white. The 50-period moving average still positive upslope. And again, my research shows that when the slope of the 50-day moving average is up, then it's a good thing for equities, and you can see how that's been true. And you can see how the steepness to the line, it's getting a little steeper. That's why it's coded green on that daily market mosaic, and that means it's very strong. And you know, the 10-period moving average, very strong here. The red horizontal lines are support levels from previous excursions to the downside. The black line in the center is the regression line, the 30-day regression line, and then the outer black lines are the channel formed by the maximum excursion from the regression line during the look-back period, which happened around the 1st of February, this sort of pullback. So a very tightly constrained channel marching northward. That's the very definition of a bull quiet move. You know, extremely narrow volatility, persistent upward movement, very tightly bounded. Price is right on that regression line, you can see. So price is better than the 10, is better than the 50, is better than the 200. That's a bull market. The ADX, you see, is up here at around 37 and some change. Bull is clearly in charge. It's hard to sustain it at that level. Like, it rarely stays above 35 for that long, in the same way that it rarely stays below 15 for that long. And you can see what this looks like. It was down around 10 towards the end of December, after that very choppy sideways market that we had that went all the way back to October. And now from right about here, you can see 30 days ago, that market went from about 10 ADX and absolutely untrending to a increasingly strong trend. And now you can see what that looks like. This is what 35 or 37 looks like in the rearview mirror. Okay, looking at the Williams percent R10, you can see that we're still overbought, and we can stay overbought for a long period of time. This was just that one little moment when we came out of this strong trend. Otherwise, it's been pretty much pushing the upper boundaries, making new 10-day highs all the time. Percent price oscillator has crossed back over itself. The jaws are starting to open a little bit wider. It'll be very hard for that to get extremely aggressively optimistic, simply because the trend has been going on for so long. It helped us with turning points in the trends earlier, like it picked up this move right here in the end of December pretty quickly. And but now the difference between the fast and the slow moving average is really small, simply because everything it's been going straight up for the last 30, 40, almost 50 days. So as a turning point indicator, it really won't help us on the upside, but then we can see that it's a strong bull. It'll help us when it threatens to roll over, like it did here at last Friday, and then the Friday before that. The slope, this is the time series on the slope of the 30-day regression line. It's still well above zero. It started decaying a little bit here at the end of last week, but it's still in positive territory. As long as it's above this dotted line here at zero, then the slope is upward, and then that defines a bull market. So right here, I want you to notice around 19 December, it certainly didn't feel like it, but that was actually the early entry, early warning for what has become a really nice bull move. So knowing when that slope goes positive and negative becomes really important, because that defines the overall trend direction. Moving on. Quick look at the ETF2 candidates. They're all on a buy signal compared to their moving average filter. SPY at 63 is still better than EFA at 55. So in the global scene, U.S. is better than the world. Still bull quiet. Inside the U.S., it's the Qs, IWM, spiders, then the mid caps. The two strongest are the technology and small caps. Two weakest are Japan and then the Euro-Asia blend. Still at 100% invested, 0% cash. Moving on. World market model, starting with the U.S., everything is above average. Small caps are really dominating here. Small cap value, IJS, is a way to play. That's this, except for Sweden. That's I'm sorry, this is the strongest. That's the strongest one on the board right now. A small cap value. That's IJS. ETF2 has that. Has had it for a while. That's a good way to play that. The rest of the U.S. is above average. Mexico, Brazil, Latin America, all above average. Emerging markets are now above average. Only Canada is lagging in the Western Hemisphere here. Some of the Asian countries starting to continue to do well. South Korea, Singapore, Hong Kong, those have been the winners. India, China are lagging. Japan lagging, coded yellow. Only Sweden is standing out in Europe. And now you have some winners and losers emerging. Winners, Germany, Netherlands, Austria, UK. It is the aggressive sectors. The risk-on trade is being rewarded in the U.S. and globally. Materials, energy, finance, industrials, and tech, the top 5. They're all above average, and U.S. finance leading the way. And now the things that did very well last year, staples, utilities, healthcare, and discretionary, are starting to lag. So that is clearly a move away from defense towards offense, towards going from risk off to risk on. Moving on. Quick look at the top 30 in the ETF2 database. Home construction remains at the top. Biotech has been remarkably strong. Retail, XRT and RTH still up there, semiconductors. The NASDAQ. S&P technology is XLK. Discretionary now is leaving XLP behind. And then small cap value at VBR. I would also point this one out here, the small cap 600 IJR in good shape too. Moving on. Among the Dow 30, using the same basic methodology, only now what I'm doing is sorting by the strength column. The winners, Bank of America, Home Depot, Caterpillar, Microsoft. GE's been good. At the very bottom, Alcoa, Johnson & Johnson, Coke. Now what's interesting, again, because this comes from a subset of the database. It includes just the Dow 30 and the ETF 30. You'll notice that the worst performing member of the Dow, Alcoa, is still ranked at 58. And so what that says still is that U.S. large caps are still leading the way compared to the rest of the world. Moving on. ETF liquidity, really not much change there. I'll just highlight the VIX is of interest to me. It's 5.70%. Spider is very quiet at 1%, so the VIX is almost 6 times as volatile as the U.S. Gold at 1.15%, just slightly more volatile than the spiders. Moving on. We're going to shift now to the daily trading plan. Excuse me. There we go. I'm not going to read the top row again. No signals in overreaction or channeling. You can see that volatility has bottomed out here. right around 1%. And ADX is almost off the chart at 37 and some change. 10-day min pain, Home Depot, Walmart, 3M, Verizon, GE. 10-day max pain, Alcoa, Bank of America, Kraft, Johnson & Johnson, Hewlett-Packard. The VIX, metals and mining, gold miners, Australia, and silver among the 10-day max pain for the ETFs. Got silver on a triple screen, Alcoa and Kraft on triple screens, channeling on Kraft. Nothing on the auto framer comes in at better than 2-to-1 reward to risk ratio. So, and that's just that's always going to be the case when it closes at a new 10-day high. Very few patterns of mine will fire when we're at runaway breakout conditions. Moving on. Excuse me. Dow Tactical Summary, you can see we've got quite a few dojis to work with here. Channeling and Kraft, triple screen and Kraft, max pain and Kraft is number 2 on your max pain range compression. It's frog standard deviation of 15 cents with a range stat of 55 cents. Says there's, even if you waited for that 15-cent retracement, there's almost a 3-to-1 trade waiting for you. Shifting over to the ETF 30 summary. Fewer dojis available. Let me let that pull up for you. There we go. Dojis in industrials, the diamonds and Brazil are on dojis, and in oil. VIX was down 1.3% after being up 10% compared to the 10-day high, or where it was 10 days ago, excuse me. Silver was a % loser. We have a triple screen in silver, and then max pain range compression here. Coal, silver, treasuries, materials, and Asia less Japan. Frog quality number, you can see quite a few of the big 30 that have exceptionally high reliability on their daily ranges compared to their variation. U.S. real estate, agriculture, small caps, that's nice. That's good for the intraday frog trading, let me tell you, at 3.2 with a 32-cent standard deviation. I can remember last August when that was almost $2. So a full 85% of the volatility in the small caps and variation in the small caps been squeezed out of it. Russell mid caps are like that too, and consumer discretionary also above 3. Moving on. Looking at the market mosaic next. You can see that slope of that regression line. R squared still well above 0.9, meaning it's very clear, strong upward trend. Had just a little bit of volatility creep in the last 2 days, which is the reason why it's so close to its 10-period moving average and why R squared came down a little bit. It's really not making a much stronger slope upward. It's hard to, given that we've had such an incredible run up, and you can see that on the percent stretch compared to the 200-day moving average. We're now almost 9% above that now, actually almost 10. So it's had, after that great sideways choppy market we had in the last half of 2011, it's really turned around and powered higher. So we're at really at new highs compared to the last 180 days. So the resistance overhead is starting to melt away. Moving on. We'll just take a quick look at the percent or the holding X days report. See if there's anything we want to highlight in here. Let's start looking just at the 40 and the 20 for the longer term holding periods. And the Z-scores, you'll notice, are for the 40 days for SPY and the Qs. Those are all above 1. So we've had, actually, we're starting to have abnormally good intermediate term moves. That 40-day move in SPY has returned 10% when the maximum normal move has been 9%. So we're starting to get into irrational exuberance. We've already crossed over that line. Same thing in the Qs. The Dow has lagged a little bit, but mid caps and the small caps. So the whole U.S. complex, less these conservative ones, are now over 1.0 on the Z-score, and that's a bit of a cautionary tale. For the last 20 days, the Z-score is still comfortably under 1.0. So no reasons to worry there, but the longer-term guys are really feeling good about this market. All right, so that's simply a way to just make sure your stocks are transition. Shifting back now to the alpha stat. What is this telling us? Well, we're looking at the 30-day relative strength using the slope of the regression line and subtracting the market from each of these major indexes, and then seeing where they are in their recent historical performance. So right now, you have all the U.S. markets have given back some of their strength. You can see that 2 weeks ago, they were all dramatically outperforming the U.S. Then as they've cooled off and people have been locking in profits, we're now kind of back to the zero line or just slightly below. And that's been a market that is digesting its gains. We haven't had runaway breakout moves to the upside of the market. It's been getting a little bit harder. And that's sort of typical of a market that has had already started to have an extraordinary 40-day move. The incremental money, in my view, is put in there. How much more money is on the sideline that hasn't yet committed to the U.S.? And I think that's why we're seeing a little slowdown in buying, lack of volatility. It's getting very quiet. That's a caution. Plus, we've got strength in oil and concerns in the Middle East. So oil is well above the market relatively. At this turning point down here about 15 days ago was an alert to start looking at the at a pair trade with oil and equities. And now the internationals have all pulled back to zero or well below the zero line. This is just indicative of a market that is starting to get a little bit long in the tooth. And what I would say is you can stay overbought for a long period of time. Just make sure that your profit preservation stops are in on your swing trades. That's everything I want to look at on the daily trading plan. I want to shift to some charts of interest now. This what I want to show you here is what I call my swing trade frame for the VIX. And now I'll show you some other charts, but you'll get the main. You're going to get the main idea on this one. As you know, I'm very interested in defining what is normal and what is abnormal, and understanding the boundary in between them. You've seen me intraday and even in some swing trades use 30-period Bollinger Bands, and then out to +1, 2, and 3. And you know that I like to use average plus or minus a standard deviation to define normal. Well, this is a version of that. What you see here, instead of using Bollinger Bands, what I've done is I put Keltner channels on this Renko chart. Okay, so a Keltner channel is a measure of volatility, but which uses ATR to measure volatility, as opposed to the Bollinger Bands, which looks at the volatility of price. So, and as you know, I'm using 30 periods for the Bollinger Band. Keltner channels that use a smoothed measure of volatility, the ATR and the ATR percentage, it is going to be a little more stable than the than Bollinger Bands. And you can see how this Keltner channel here in the middle is, I'm using a 30 period look back. The normal on Keltner is 20. I just like using 30 to keep it standard for statistical purposes. I'm showing the boundary here as 2, plus or minus 2. So the outer red lines represent the average plus or minus 2 ATRs among this 30 period exponentially smoothed average. That's what the dotted line is, the mean. So I define, for this look back period, which is about 6 months, that central road, it looks like a road to me, a 2-lane road, defines the boundary of normal. Now each of these little candles you see are of uniform size, or roughly uniform size. They are actually ATR blocks. Based on the ATR right now at $1.55 in the VIX, so we're looking at the VIX. The ATR right now is 1.55. So this computes backwards to find each move of $1.55, and you'll notice that the time frame is not to scale. So it doesn't really care how long it stays inside that box. It just, every time a new box is made, it advances the candle one period or one frame forward. So you can see that the volatility moves here happen an awful lot faster recently than it did, say, back in October, November. Now, the other things that are on here are just a 3-period moving average, which I'm using as a proxy for price. And what I want you to notice is that you get long, clear price trends when you screen out the time and you make this just ATR move. So if you're interested in doing swing trades and you think your profit target, or your initial stop is going to be some measure of an ATR, a Keltner, a Renko chart gives you the ability to see what kind of uninterrupted moves of ATRs this instrument is capable of. So when we had this double top here at 48 in the VIX, it was right at the boundary of normal, and then it reversed. When I see that reversal, I'm always estimating initially a target at the mean, and then at the far side of the Bollinger Band, and then and beyond. And what you saw, this move from 48 to 26 was an uninterrupted move of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 ATR in one direction without a reversal until most recently, when it went from, it's in this boundary between 26.5-ish and 28. So right now the VIX is trading at 27.90. In other words, just right under that 28. And what it's done is it made a 14 ATR move uninterrupted in one direction, so strong that it actually pulled the mean, and the Keltner channel started to have it roll over, and it got as low as 24, and then it reversed up to 26 when it filled in and started making this this first white candle here from 26 to 28. So it's made a 2 ATR move off of its bottom at 24. And so now I set myself these kinds of targets. I would not be surprised to see it get to 33, which is the upper boundary of normal. The lower boundary of normal. And then 37-ish, which is the median. And then about 40-ish, which is the upper bound of normal. And you can see how the last time it made a move like that, from an extreme move up and then a reversal. So if you were going to say, let me have a 2 ATR move at a local maximum or minimum that's outside of the Keltner channel, you could play with a 2 ATR stop. You could say 1.5R, 3R, 5R, 7R on that kind of a swing trade to get to the far side of normal. And then when it made its change here, you'd end up getting in around 40. And then even with a 2 ATR stop, you're getting out of somewhere around 46-ish, 45. So I like instruments that trade with these long directional trends. If you set the Keltner channel at 2 ATRs, what you can say is a move from one side of the Keltner channel to the other side of the Keltner channel, by definition in this setup, is 4 ATRs. So if you simply, like right here, bought the crossing of the Keltner channel with the target on the far side, and you're using 2 ATRs as a stop, you have a 2R trade automatically framed simply by the way the instrument is calculated and calibrated. So I'm very interested right here in this volatility reversal in the VIX. It's moved 2 ATRs off its low. The market has been in that, if you remember from the weekend report, it's been exceptionally quiet for a long time. And so that automatically makes me interested in a ETF that's going to do well when volatility increases. So I have a buy order in at 28, which is basically just about ready to get hit because price is at 27.90. Any kind of breakout, it's going to get me in with a $4 initial stop, and now I have a swing trade on that'll where I'm looking to see 33, 37, and then 41 as reasonable targets in some period of time. And you can see from December to February, the VIX went from 48 to 26, and I'm looking for intermediate retracements here. So that's the general idea of using Keltner channel and Renko charts to frame swing trades. What I want you to notice is I had some trade frames intraday during this last week where I was trading inside the yellow zone, and basically what I'm doing there is looking for, in the yellow zone, I'm looking for internally consistent 2-to-1 reward to risk ratio. So I'm not in those trades very long at all, never overnight. But now I'm at the position where the VIX is becoming an interesting overnight hold for me here because there's a full 2 ATR move off the swing low of 24. All right, so now let's take a look at some other. As an example of a trade, let's see if I can get this. Yeah, so this is the next one. This is an intraday trade on the VIX. And this was on the 17th. And what I want you to notice is the now what this is the regression line crossover on February 17th. So this was a Thursday trade. I'm getting an entry down here at right around 1 o'clock. The VIX had gotten as high as 27.30. Sold off, went through the Bollinger Band, got below the VWAP here, the volume weighted average price. The Bollinger Band had rolled over. Had a crossover signal. You could actually gone short the VIX at 27.10, and you'd have been looking to cover around somewhere around 26.75, and that was a reasonable trade. But now you get the next crossover outside of the Bollinger Band here, and so I took an entry at 26.65 with a stop of about 20 cents. Ended up getting a nice play, and you'll recall that Friday the VIX closed at almost 28, so there was a $1.40 move off of this, that provides a nice intraday trade possibility in the VIX. Lisa asks, why should the crossover be outside of the Bollinger Band? Because I think that becomes it's a reversion to the mean from a significant distance from normal. See, when the crossover occurs here at 2710, now you have a reasonable distance to move, either to get to the mean or the far side of the Bollinger Band. If you trade the crossovers inside the blue, there's just not enough room inside there to get significant intraday moves. So I like to see moves. I like to see the crossovers here outside of the blue, and then play either for the mean or for the far side of the Bollinger Band. So that's an example of a yellow zone trade in the VIX, and now it's supported. Now it actually moved far enough off there to almost close at 28. That now becomes an interesting, further interesting trade. Here's Alcoa on a swing basis. This is one of the reasons I love Alcoa. Look at these long orderly moves. Comes back to the mean of the Keltner channel, then moves up 10 ATRs in a row, then down 10 ATRs to the mean and bounces. I like this on the long side. So with a stop below 10.10, I can buy it at 10.25 and have 3 ATRs off the bottom with a reason to believe it could get to 10.50 pretty without too much effort. And that's the worst looking chart in the Dow right now. These were all part of the thought experiment package I put out there Thursday. I was looking at a pair trade, taking the same idea and now expressing it as a pair trade, comparing the rest of the world to the S&P. And now what you see here is, because the EFA is first, this whole period of time here, all these red markers are places where Europe and Asia are getting measurably worse than the U.S., and you get these little short rebound trades, but they just get back to the lower end of normal. So you can see the Keltner channel shows the rest of the world has just been getting horrible compared to the U.S., and then you get long periods of U.S. outperformance, short periods of rebounds in Europe where they try to fix things, but then it just keeps getting worse. So if this rolls over again, we could expect to see another long period of outperformance by the U.S. compared to the rest of the world. Moving on some more. Oh, this one was I found this one kind of interesting. This is the Dow compared to the S&P, looking all the way back to August. And these periods of big white candles are when the Dow was in the ascendancy. So in the last half of the year, the Dow was very dominant compared to the S&P. But right around the start of the year, you start seeing the growth on the risk on trade, and now the Dow is starting to suffer compared to the S&P all the way back down to normal. So you can almost see the change in mindset from the end of last year when it was U.S. large cap dividend payers had been dominating, and now as confidence has come back into the market, that money has been shifted now into the small caps, mid caps, and tech, and that's why you see the Dow now suffering compared to the S&P. So it sort of confirms what we already knew. This is oil, and it's now starting to the price of oil is starting to get noticeably high, up around 39. If it were to roll over here, it can come. This says, hey, there's it can come all the way back down this far to 30. I mean, normal would be 36.5, then 34.5. But if it fails here, you can go short at 38 with a $1 stop, and then still have a 2-to-1 with a target at about 35. So for the energy sector, that's the next interesting trade. Treasuries. You'll notice here that they have gone from having an extraordinary set of runs, 2 of them, to now it's had one serious pullback, and now a couple more where it's just slowly degrading. Again, this is part of that risk-on trade that is money moving from treasuries over into the equities. It's still just back to normal. There's a lot more money in treasuries, from down around 105. That's a 15% drop in treasuries potential. No, 10%, excuse me. That's about a 10% drop in treasuries still available, and that's all money that could be cashed and put into the equities. And so there's still room for some slow believers to the equity play to start expanding their exposure to the equity side. So that's not impossible. So treasuries should be protected. Your profits in treasuries should be protected. That's where the next tactical surge in the U.S. could come from, as that conservative money starts shifting. This is Brazil. Now, we've been talking about Brazil in here for at least a couple months, and this is very interesting. Look here, you had a 9 ATR adverse move down to about 50 in Brazil, followed by a 1, 2, 3, 4, 5, an 8 ATR move up, and then a 6 ATR pullback, then a 4 up, 3 down, and now a 10 move up, and now it's cleared resistance, and now it's off and running. So we picked up the stealth move in Latin America and Brazil a couple months ago on these higher lows, and then it started showing up in ETF2 week over week. Still an interesting play. It has cleared resistance at 64, and it's well postured to keep going. So I like how clearly this displays in the combination of Renko and Keltner channel. Russell small caps, the same issue, even stronger than Brazil because the pullbacks are less and the breakout was more substantial. The breakout above 74, that double top and go. That's where it left the Keltner channel. That's a very interesting way to start framing potentials for swing trades among your favorite candidates. That's the unmarked up VIX. You can see why I'm interested in the VIX now. It's had a 2 ATR reversal at a very extreme move. This is gold, has had a nice run up to 170. It's at the far end of the Keltner channel. And if equities get another, it has made this move while equities have been creeping up in a bull quiet. But it could definitely get up to 180. If equities had a sudden system shock here, 180 is definitely within target. And this makes the case for why gold was attractive around 152. There was, it had a 8 ATR move to the downside, had a 2 ATR move off the bottom. You can see that's what it takes to turn that 3-period moving average around, and now it's all on the upside of that 3-period moving average, and that was a 1, 2, 3, 4, 5, 6, 7. That's a 3R move if you simply used a 2 ATR trailing stop. So I think for swing trade frames, you get some very interesting simple signals here using this general strategy, combination of Keltner channels to define what the normal range is, and then it gives you 4 ATRs between the outer lines, and then now crossovers that occur outside of the Keltner channel gives you reasons to look at a target of the near side, the mean, and the far side, and gives you a way to start bracketing or ratcheting your stops as you move up. Very, very interesting technique that I think is worth a little bit of study. Let me see if I could put some. Silver would look very much like gold in that same vein. So that's the charts of interest for this week. I got to get back into grading papers, but I'll have this processed and hung up on YouTube. And again, I'm very close to getting started on the home study course. I'm satisfied with the material that I have to cover almost like chapters on beliefs, systems, and market. beliefs about the system, about systems, belief about the markets, belief about self. The usual things that I start off on day one on seminars with. I'm ready to record those, and I'm going to get that produced and made available to you guys. And of course, subscribers will get a good deal on it, and then IITM members will get a good deal, and the rest of the world can pay for my time. So keep your powder dry, and we'll see you in the chat room. Keep your risk measured. Protect against that downside. The market has been quiet, very quiet, and so the sudden system shocks. You're starting to see the price creeping up in the VIX. That's people starting to buy portfolio insurance, in my view. So let's be alert to that possibility. So take good care, and we'll see you in the chat room.